Hi, this is Juliet Arfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 11 about investments in equity securities and debt securities. I discussed in part 11 about bifurcating a compound financial instruments. Just click above or the link below this video to watch part 11. In this video, I am going to discuss about reclassification of debt securities and disclosure requirements. Reclassification of debt securities into financial assets at fair value through profit or loss. An entity shall not reclassify debt securities that were previously designated as HTM or AFS into financial asset at fair value through profit or loss, from held to maturity securities to available for sale securities. If, as a result of a change in intention or ability, it is no longer appropriate to classify an investment as held to maturity, it shall be reclassified as available for sale and measured at fair value. The difference between its amortized cost and fair value at the date of reclassification shall be recognized directly in equity, assuming that the fair value is higher than the amortized cost. The entry for the reclassification is debit available for sale securities at amortized cost, debit market adjustment fair value greater than amortized cost, credit held to maturity securities at amortized cost, credit unrealized gains or losses on available for sale securities. From available for sale debt securities to held to maturity securities. If available for sale debt securities are reclassified as held to maturity securities because of a change in intention or ability, the fair value of the securities on the date of reclassification becomes its new cost or amortized cost. The change in market value from the last reporting date to the date of reclassification shall be taken up. To illustrate, assume that ABC Corporation purchased XYZ 8% bonds on March 1st, 2007 for 277,870 pesos. The bonds pay interest annually on December 31st. The bonds were purchased to yield a rate of 10%. Amortization of the bond discount had been appropriately recorded until a market value of 290,000 pesos on January 1st, 2009. On this date, the company, with an intention to hold the bonds until maturity and demonstrating its ability to hold the bonds until maturity, decided to reclassify the bonds as held to maturity securities. The following are the relevant ledger balances as of January 1st, 2009, before the reclassification. Available for sale securities, 285,129 pesos. Market adjustment, available for sale securities, debit, 4,871 pesos. Unrealized gains or losses on available for sale securities, credit, 4,871 pesos. XYZ shall prepare this entry on January 1st, 2009. Held to maturity securities, debit held to maturity securities, 290,000 pesos, credit available for sale securities, 285,129 pesos, and credit market adjustment on available for sale securities 4,871 pesos. This entry leaves a credit balance in the unrealized gains or losses account of 4,871 pesos. This amount shall therefore be considered in determining a new effective interest on the instrument. The amortization of the discount and the remaining balance of the unrealized gains or losses account shall be recorded as follows. Debit net unrealized gains or losses on available for sale securities transferred to HTM. Debit held to maturity securities. Credit interest revenue. Reclassification in rare instances from FVPL or AFS into loans and receivables. The IASB, in response to world financial crisis that was observed during the latter portion of 2008, issued amendments to IAS number 39 and IFRS number 7. In a press release issued by the IASB, the deterioration of the world's financial markets that occurred during the third quarter of 2008 is an example of rare instances cited in these amendments. The amendment permits an entity to reclassify debt securities from FVPL or AFS to the loans and receivables category if two conditions are met. Letter A, the instrument meets the definition of loans and receivables. And letter B, the entity has the intention and ability to hold the financial asset for the foreseeable future. At the date of reclassification, the securities are measured at fair value. The fair value at the date of reclassification becomes the instrument's amortized cost. If the reclassification is from FVPL, the adjustment to fair value previously taken to profit or loss shall not be reversed. If the reclassification is from AFS, any unrealized gain taken to equity shall be amortized over the remaining term until maturity. Similar procedures are applied as if the instrument were reclassified from AFS to HTM. Disclosure requirements. IFRS number 7, Financial Instruments Disclosures has the objective of providing users with information which allows them to evaluate the significance of financial instruments in assessing an entity's financial performance and position. The following information are required to be disclosed. Letter A. On the statement of financial position, the carrying amounts of each class of financial asset disclosed separately. Letter B. The carrying amount of the financial assets pledged as collateral for liabilities or contingent liabilities and any significant terms and conditions attached. Letter C. The amount of financial asset that has been reclassified, if any, and the reason for the reclassification. Letter D. Material items of income, expense, and gains and losses resulting from financial assets, whether included in profit or loss or a separate component of equity. For this purpose, the disclosure shall include at least the following items. Number 1, total interest income, calculated using the effective interest method for financial assets that are not at fair value through profit or loss. Number 2, for available for sale financial assets, the amount of any gain or loss recognized directly in equity during the period and the amount that was removed from equity and recognized in profit or loss for the period. And number 3, the amount of interest income accrued on impaired financial assets. Number 4, net gains and losses on the movement in financial assets measured at fair value through profit or loss. Separate disclosures should be shown separately from financial instruments designated as FVPL and those that are classified as held for sale. Letter E, the accounting policies and methods adopted, including the criteria for recognition and the basis of measurement applied. Letter F, transparent information about the risk that exists in relation to its financial instruments and how the equity controls those risks. The disclosures on risk should be broken down into qualitative and quantitative in nature. Qualitative disclosures include the entity's exposure to risk, how the risk arises, and the entity's policy on monitoring and managing risk. Quantitative disclosures include the different risks, being credit risk, liquidity risk, and market risk. Letter G, the fair value of the class of financial assets in a way that permits it to be compared with the corresponding carrying amount in the statement of financial position. Letter H, whether fair values of financial assets are determined directly, in full, or in part by reference to published price quotations in an active market or are estimated using a valuation technique. Letter I, the nature and amount of any impairment loss recognized in profit or loss for a financial asset separately for each significant class of financial asset. The following disclosures shall be made in the financial statements for investment in associate, IAS or PAS number 28, investments in associates, paragraph number 37 to 40. Letter A, the fair value of investments in associates, including the aggregated amounts of assets, liabilities, revenues, and profit or loss. Letter B, the reasons why the presumption that an investor does not have significant influence is overcome if the investor holds directly or indirectly through subsidiaries less than 20% of the voting or potential voting power of the investee but concludes that it has significant influence. Letter C, the reasons why the presumption that an investor has significant influence is overcome if the investor holds directly or indirectly through subsidiaries 20% or more of the voting or potential voting power of the investee but concludes that it does not have significant influence. Letter D, the reporting date of the financial statements of an associate. When such financial statements are used in applying the equity method and are as of a reporting date or for a period that is different from that of the investor, and the reason for using a different reporting date or different reporting period. Letter E, the nature and extent of any significant restrictions on the ability of associates to transfer funds to the investor in the form of cash dividends or repayment of loans or advances. Letter F, the unrecognized shares of losses of an associate, both for period and cumulatively if an investor has discontinued recognition of its share of losses of an associate. Letter G, the fact that an associate is not accounted for using the equity method. Letter H, summarize financial information of associates either individually or in groups that are not accounted for using the equity method, including the amounts of total assets, total liabilities, revenues, and profit or loss. Letter I. The enterprise share of the contingent liabilities of an associate incurred jointly with other investors. And letter J. Those contingent liabilities that arise because the investor is severally liable to all or part of the liabilities of the associate. Thank you for watching my video. I hope you learned something from this video. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.